All right, let's get into it. Today, we're putting two energy companies in the ring, Berry Corporation versus W&T Offshore. We're going to go head-to-head, break down their numbers, see how they're built, and figure out what really makes them tick. So on the surface, these two look pretty similar, right? They're both in the oil and gas game. But when you start digging into their financials, well, that's where the stories really split. Who's got the stronger foundation, and maybe more importantly, who's actually in control? Let's dive in and find out.
Okay, so let's meet the contenders. Time for a proper introduction to the two companies in today's matchup. So in one corner, you've got Berry Corporation, and in the other, W&T Offshore. Now you look at what they do, and it's basically the same thing. They're both independent producers, pulling oil and gas out of the earth. But trust me, that's pretty much where the similarities stop.
All right, first up, every good fight needs a weigh-in, right? For companies, that's market capitalization. It's just a fancy way of saying the total value of all their shares. It gives us a quick idea of who the bigger player is. So let's see how they stack up. First on the scales, we have W&T Offshore, coming in at about $291.5 million. And right behind them, Berry Corporation tips the scales at just over $311 million. So when it comes to sheer size, they're pretty evenly matched. But, we all know size isn't everything. It's about the financial punch they can pack. Okay, so let's pop the hood and really see what's going on with the engine. The sticker price, that market cap, doesn't tell you anything about the company's real financial health. To understand that, you got to look at their debt. What do they actually owe? And the key metric for that is total liabilities. Basically, it's the sum of all their debts and obligations, both short-term and long-term. It's a huge indicator of just how much financial risk each company is carrying around. And wow, when you look at the numbers, the difference is pretty stark. W&T Offshore is sitting on about $64 million in liabilities, but Berry Corp, they're carrying over $162 million. That is a massive difference, and it tells you these two companies have completely different ideas about how to handle their money and risk. So, the debt picture is clear. But a company's story isn't just about money. It's also about power. Who's calling the shots? Who gets to make the big calls that shape the future? To figure that out, we have to look at who actually owns the company. And this is so important because it tells you a ton about their strategy. Is the company being driven by a small group of insiders with a ton of skin in the game? Or is it more democratic, with its destiny in the hands of the public market? The answer completely changes the game. Let's take a look at W&T Offshore first. You can see that more than a third of their shares are what we call closely held. That means insiders, we're talking executives, founders, big-time investors, they own a huge chunk. This gives them a really powerful voice and a ton of influence over the company's direction. Now, flip over to Berry Corporation, and it's a totally different world. Look at that. Only about 3% of their shares are closely held. Almost 97% are free float, which means you and I and everyone else can buy and sell them on the open market. This points to a much, much more decentralized power structure. The influence is spread out. Okay, so we've covered their size, we've looked at their debt, and we've figured out who's in control. Now it's time to bring it all together for the final scorecard. Let's lay out the strengths and weaknesses side by side. So here's how it all shakes out. W&T Offshore, they look stronger on the performance side, things like profitability or EBITDA, and they've got more cash for every share out there. The big but is that tight insider control. Then you've got Berry. Their big pro is that they're owned by the public and have less short-term debt. But they're carrying way more long-term debt, and they're just not matching W&T on those performance numbers. So you see, it's not really about who's better, it's about two totally different company philosophies. So what's the market thinking? What's the road ahead look like? Well, this chart gives us a little peek into the future, and it's kind of messy. The lines are all tangled up, which tells me that even the experts think this is going to be a close race. There's no clear winner on the horizon. The future for these two is definitely up in the air. Which leaves us with a really interesting choice, doesn't it? It all comes down to what you value more. Do you bet on the company with the stronger performance numbers, even though it's run by a small group of insiders? Or do you go with the one that's owned by the public, even with that bigger pile of debt? It's a classic showdown between performance and power. Definitely something to chew on.